I've got a new formula. We love formulas. We love to actually blow up formulas here on this show. The rule of thirds. They're going to parcel your money up in 3 different places. This is a new one on me, Charisse. This is how we should parcel up our money. 1/3 in guaranteed income. That's your Social Security, pensions, and annuities, things like that. 1/3 in fixed income investments. That would be bonds, CDs, and Treasuries. And 1/3 in equities. So just parceling things up. Is there a percentage that you would have in each of these buckets? Or is this crazy, Charisse? Is this just another clickbait? Is this good stuff? What are we saying here?
Is it clickbait? I mean, yeah, it's actually really good clickbait. By the way,
because I clicked on it, yeah.
You clicked on it. So you can follow the rule of a third, a third, a third. I think you can get yourself in a little trouble there. What I do like about the third rule, so making sure that your fixed expenses are totally covered, I like that third. But some people need more than a third of their assets to cover the fix. So now you're really looking at 50-50, because if you got a smaller Social Security, no pension, then you got to put more money into this annuity to cover that fixed bill environment for the rest of your life. Then you only have 50 left over. I want to squash the strategy, but I want you to understand the thinking is valid. I don't like having a third of our money. This says a third of our money in fixed instruments like Treasuries, bonds, and CDs, because people take that to the next level. And all of a sudden, if you got $1 million, you're like, I'm going to go put 300,000 in CDs. No, we don't want to do that. Or I'm going to put 300,000 in money markets. No, we don't do that. Or 300,000 in Treasuries. No, we don't want to do that. But we do want to think through it and maybe sprinkle a few dollars in each one of those investments and really decide how that bond portfolio's outlay is going to look, and then sprinkle in some other strategies. I call them safe money strategies that could be even more icing on the cake. Let's put it that way to your investment portfolio. The other third is the stocks, mutual funds, and equities. Well, number one, we do not like mutual funds, and you shouldn't either, but until you sit with me in my office, you won't know why. But we do like stocks and dividend stocks, and we do like exchange traded funds. But I think the first question we got to ask is, do you really put a third of your money into the stock market? And you're 65 years old, or between 65 and 75 years old. That's the part you really got to think through. Like, do you really want to risk a third of your money? How much of that third do you need? And is it really half of your money you're risking? Remember, we used to talk about the 40, 30, 20, 10 strategy? Maybe 40% of your money definitely buttoned up safe, 20% at risk, 30% somewhere in the middle, and the other 10% is part of your income and liquidity phase that you need for the next couple of years. But if you're trying to dial in, leave more of a legacy, make sure there's a long-term care plan built in, make sure that, there's assets there for when you pass away for the surviving spouse. You probably need to delve in just a little bit more, build that income plan to make sure that does make sense, because I have not met too many of my clients where actually that would make sense. I would say a few probably certainly will, but I think for the moral of the story is the guaranteed income is like, it's absolute certainty. It's going to be there. The other third is the fixed income, the safer stuff. Hey, this is our money that we're going to be living on most likely for the next 5 to 7 years. And then the third portion of our money is like, okay, how much can we lose and emotionally handle to lose over the next 10 years if we don't need to touch it? So I'm okay with a third of your money in the stock market if you promise that when it goes down and crashes and burns, could be next year, it could be 3 years, it could be 10 years now, wherever it is, that you're mitts off, you're not going to sell it at the bottom. Therefore, you're also not going to need it when it hits the bottom because you have your other buckets full. So you really got to think through it. So it's just a good start.
Talk about the 3 aspects of retirement planning, and every retirement plan has to have preservation, income, and growth.
Yes.
Now, that spells pig, so it's not a great marketing campaign. But actually, these 3 kind of go along with that. The guaranteed income is your preservation, your income, and then the third in equities is your growth. So there is some truth here, and there you can start maybe use that, as we say many times, as a guideline, as a starting point, and say, how much of my income do I need here to make up what I need? How much do you need per month for essentials? How much do you need for fun? Let's figure that out. And that is what it is to sit down with Charisse. Give us a call. Give the team a call. Let's get our priorities straight. That is why you would bring all of this to Charisse and let her worry about that part. You worry about having fun and having a great time in your retirement.